I'm Greg Hunter. Welcome to USAWatchdog.com. With us, the best-selling author, number 4 on the New York Times bestseller list of this book, The Great Deformation. You can see the name at the bottom, David Stockman, former White House budget director. He's got a very deep resume, financial expert extraordinaire. David Stockman, thank you for joining us today on USAWatchdog.com.
Very happy to join you, Greg.
I saw, and I want to start here because this book is a message, and the message is clear, and it's backed up with your vast experience and data analysis. And I saw you on a CNBC interview recently. I think it's Fast Money. And the guys interviewing you couldn't even maintain eye contact with you. And they were just like, oh, gosh, man, you were just one fact after another about how bad the economy is. And at the end of the interview, and about how much debt we cannot push into the system anymore. Right. And at the end of the interview, they say to you, well, that's one view. And I'm thinking, how many views can you get with that kind of data? Are you finding this pushback from mainstream media in general, not just CNBC, but in general, when you're out talking about how the die is cast, that the economy is going down, the markets are going down? Are you getting a lot of pushback?
Oh, there's tremendous pushback, but that's why I call it bubble vision. My view is not in accord with the authorized theory that everything is awesome, that the central bank and Janet Yellen are totally in charge of our destiny, that the world economy is in great shape, maybe stuttering here and there, a little oil's taking a dip, that everything will be better soon. That is what I call the mainstream narrative. I think it's totally wrong. You raised the image of my book there. I spent 730 pages trying to lay out why we are in a giant artificial bubble created by the central banks over the last several decades that's nearing the end. It's at its apogee. I think the world economy is now plunging into an unprecedented deflation, recession, period of shrinkage that will bring down all the markets around the world that have been vastly overvalued as a result of this massive money printing and liquidity flow into the Wall Street and other financial markets. So obviously they didn't want to hear this, but it's interesting. It was actually the host who didn't want to hear it. He is a CNBC regular. He's part of the daily dog and pony show. You know, the water's warm, stick in your toe, buy some more stocks. Actually, many of the panel members are as skeptical of where the world is going and the markets are heading as I am, only they can't say it on the air. They told me afterwards. So
wait. They actually told you? Yeah, Dave. Exactly. You're right about this. It's tanking. They actually told you that offset?
I mean, not all of them, but some of the members of that panel are pretty serious students of the financial markets. They haven't completely lost their sanity in this great artificial phony bubble that's been created. But it's very rare that they bring a pure dissenting view onto the screen on CNBC. About once a month or so they invite me. I guess I'm the token dissenter. But look at the markets. We're off to the worst start for a year in history. The markets are down anywhere from 10% to 30% around the world. In fact, the other day in my blog, David Stockman's Contra Corner, I posted the fact that 40 markets around the world, including the stock market in Canada, Brazil, and China, and many Japan at that point, are down more than 20%. 40 markets are down something like $8 trillion in market cap and are technically in a bear market. So that is fairly inconsistent. That is a note of dissonance, not coming from skeptics like me, but from the marketplace of the world itself. They try to ignore that whenever they can on bubble vision, because bubble vision goes by the hour and the minute. There is no memory there. There is no history. It's all, I guess the market is in good shape today because Facebook posted a good quarter yesterday. That's about as far as it gets. That's, a measure of the superficiality. But it's part of why this whole central bank-driven era of what I call bubble finance is so unfortunate and dangerous, actually.
Why dangerous? Are people just well, first of all, why dangerous? When you say it's unfortunate and dangerous, why is it dangerous to the public?
Well, it's dangerous because it has lured in an awful lot of innocent people for the third time this century. They got killed in the dot-com bust. They swore not to come back in. I'm talking about regular people on Main Street who were trying to provide for their retirement or their family or to build their balance sheet. Finally, they came back in just in time for the housing bubble to crash in 2007, 2008. Something like 12 trillion of market cap was wiped out in the great meltdown that fall and winter. After swearing never again, and I think you could hear that over and over during and after the Great Recession, in the last 2 years, as Wall Street ramped up the market one more time, by huge amounts, not based on really any economic performance, and we can talk about that. I think the retail investor waded in again. The sheep lined up and unfortunately are heading for the slaughter one more time. Now, I think it's very hard to see how this baby boom generation, there's 10 million people or 10,000 people retiring a day, can afford one more devastating crash in their stock holdings, and that's unfortunately what we're heading for. So that's why I say it's dangerous, because when the bubble breaks, it will obviously spill and flow throughout the Main Street economy.
Is this bigger than any other in the past?
Yeah.
Any other, including the Great Depression?
I think we've been building a bubble year by year since the early 90s, and the earlier crashes that we are so familiar with, dot-com and the housing crash, were only interim corrections that were not allowed to work their way clear. The rot was not effectively purged from the system because the central banks jumped right back in within really months of the corrections and doubled down in terms of the stimulus and the liquidity that they pumped into the market.
You have said, and let me read this, that you just can't fake your way anymore with this market. And you said that to the fast money crowd, and they just, their faces were, And to explain that, you can't fake your way in this market anymore.
Well, I have pointed out that Wall Street continuously tells you that, well, the market's not that overvalued. After all, it's trading maybe at 16 times earnings, and that's only a tad above historical levels. What they forget to tell you is those are forward PE multiples, price earnings multiples, not based on what is actually been delivered and reported to the SEC under penalty of jail time if you don't use proper GAAP accounting. But what instead they're talking about is what I call the forward hockey sticks that come from the Wall Street sell side that conveniently forget GAAP accounting and make all kinds of adjustments and exceptions. They call it earnings X items, and items are about any charge that they can conjure as non-recurring. And as a result of that, they delude their audience, they delude retail investors into thinking that all is well and you have a decent chance to gain ground in the year ahead. Here's what I pointed out and why they were somewhat flummoxed. Earnings on a GAAP reported basis, that is what is actually filed with the SEC, peaked at $106 per share on the S&P 500 last September. I don't mean September 2015, I mean September 2014, 5 quarters ago, as I said, at $106 a share. In the quarter just ended, earnings came in at barely $91 a share, meaning that already, before real recession is even set in visibly, earnings are down by 15%. You would never know that by watching the financial media day after day. But actual earnings are down 15%. They are expensive. The market is exceedingly expensive. That's about, even at today's price, 21 times earnings. And therefore, the whole, the whole refrain that you get from bubble vision about the valuations of the market is terribly misleading. So when I say fake it, what I meant was that even the Wall Street version of earnings is going to be hard to maintain as the global recession sets in. And then investors are going to suddenly discover that the market is drastically overvalued. They're going to want to get out. They're going to want to get out all at the same time. And that creates the kind of selling panics that can take the market down. I pointed out that we've kind of been in no man's land for the last 700 days. The market is struggling to stay above 1870. That's the S&P 500. It first crossed that level in late March 2014. It has had 35 efforts to rally and break to new highs. None of them have been sustained. And my point about that is that that's the way bull markets die. In a world of bubble finance, in a world where the central banks have distorted and falsified the markets and pricing, bull markets die a slow death with a lot of, false bounces, dead cat bounces as we call them. But I think it's pretty clear now that after 700 days, the speculators are beginning to understand that buying the dips, which is what kept levitating this market in the past, no longer works. For 700 days, it's been failing unless you're an adroit trader that can move in and out of the market by the day. So I think we're in no man's land now, and we're close to a real break. And when the market breaks below decisively 1870 on the S&P 500 and stays there for a few days, then we're heading for a very deep correction that I believe will last all of this election year and well beyond.
You said in the fall, when the majority opinion, they can't raise rates. They won't raise rates. They can't raise rates. And you were like, no, they got to raise rates. Yeah. They're going to raise rates. They got to raise rates. Boom. Take a bow. They raised rates. Well, now the Fed came out late last week and said, we're not going to raise rates this time. Do they still have to raise rates? Are they going to raise rates?
Well, I think they painted themselves into a ludicrous corner, and that's actually going to work to undermine confidence. What they did was they kept the money market rate, the short-term rate, at zero for 84 months, which is just incredible. It's almost lunatic, really.
It's never happened before.
Nothing like that was ever contemplated historically. If you went back 15 years and you ask even, a liberal interventionist, the Keynesians of the day, if you will, is it feasible that in an economy that's not in depression, and our economy wasn't since 2009, that you would have zero interest rates pegged by the Federal Reserve for 84 months, they would have looked at you as if, you had a screw loose or two. And yet that's exactly what the Fed did. And they basically ran out the clock. In other words, business cycles don't last forever. No one has repealed the business cycle. This one now is getting long in the tooth. And the Fed got, worked itself into a corner where it still had zero interest rates when the recovery, at least by historical standards, was almost over. So now I think they're between a rock and a hard place. Their credibility depends on raising the rate, even if it's just by little pinprick amounts, 25 basis points, because they've argued that this massive quantitative easing and this long, unusual, almost crazy period of zero interest rates was the cure that was going to solve everything and put the economy back on a firm, sustainable, growing footing and all that. Well, to come in now and say, we're going back to zero, that the whole thing flopped, that everything we told you for the last 7 years has not materialized, I think would utterly shred their credibility. On the other hand, the markets have been so house-trained on constant injections of liquidity and a backstop, or as we call it, a put under the market from the Fed, that they're desperately hoping for relief. And so you have the Fed, therefore, I think, in the next few months, hopping from one foot to the other, trying to say, on the one hand, all this has worked, the economy is getting better, and on the other hand, scared to death that the market will lose faith, go into a hissy fit, and experience a deep plunge that would set the recession fully in motion. So I think what you're going to see is kind of what you saw last week. Their statements said nothing. Now let's remember, the statements they put out after a meeting are basically a pro forma weather report on the economy in the very short run. They're essentially meaningless. They involve observations that are so, general and content-free that you could easily formulate the same thing just by watching the daily financial news. But in any event, they reached the point last week where they said even less. We're not telling you where we're going, what we're thinking, because flat out they don't know. Now, their defenders will say this is just a measure of their wisdom and prudence. They're not going to get ahead of their skis. I'm saying it's a measure of the danger that we're in, because we have a financial market that absolutely assumes an all-powerful central bank can keep the bubble expanding, can keep the game going. And what we're on the verge of discovering is that none of that is true. And basically, they've been sliding by the seat of their pants, making it up as they go along for years now. And they finally reached the point where I say the jig is up and the bubble is really heading for a major correction.
A couple of questions about debt destruction. I mean, you're talking about Great Deformation, debt destruction,
right?
Bond destruction. The bonds are no good, i.e., Puerto Rican bonds.
Right.
They don't want. They're not going to make the payment. You said that you packed all this debt into the system, and we can't put it anymore because there's no payment stream for that debt. Correct?
Yes, and that's a worldwide phenomenon. Puerto Rico just happens to be on the news wire at the moment on the screen. But look at the shale patch. Look at the oil patch. We have had something like $500 billion of junk bonds and junk loans issued by E&P companies that funded this great surge of shale investment. But the point is, that is a technology that may or may not be viable, but it never should have been financed with high-cost debt. That is the shale production, shale drilling is on the margin of risk because it all depends on the commodity price. And anybody who looks at history can see oil commodity is one of the most unstable commodity prices there is. So none of this should have been done on massive amounts of debt. It was because investors were being forced to scramble for yield and close their eyes and ignore the risks. So there was a ready market for the E&P or shale junk bonds. A whole economic infrastructure was built up. A boom occurred in North Dakota and various parts of Texas and Oklahoma. And we're now at the point where all this debt is crashing and unwinding by the day. And that's going to be the story of 2016, the collapse of junk bonds in the oil and energy space. But it's not just that. It also is happening in manufacturing, in retail, and many other sectors. So we then could add to that scenario the $9 trillion outstanding of bonds issued in dollars or other offshore currencies in the emerging market world. That is all now hanging in the balance as well, because as the dollar continues to strengthen and these currencies weaken, whether it's the South African rand or the Turkish lira or the Chinese RMB, and you could go on, all of these issuers are now going to find it very difficult, be in desperate straits as they try to service their debt. So again, there will be more and more defaults, more and more carnage in what we call the EM bond market. It's one of the consequences of running a bubble finance system based on zero-cost money and massive monetization by not only the Fed, but all the central banks of the world.
So could you explain something to me? I know I think you're right on the money, and you're telling folks that they should hold cash if the debt, like let's say Treasury bonds, if they're no good. Are the Federal Reserve notes going to maintain their integrity if the Treasury debt is no good? Are the Federal Reserve notes still going to be good?
Yeah, I don't think the issue is that the U.S. Treasury is going to default. I think the issue is that there's been a great bond bubble in the world, and so therefore almost every kind of fixed income instrument got overpriced, from the Treasury 10-year all the way along the spectrum of things, corporate AAs, corporate BBBs, and then junk bonds, because all of them price off the Treasury 10-year at a spread that's allegedly based on some sense of incremental risk. Now, I think the danger to investors is that as the financial system unwinds and the central banks demonstrate that they're out of dry powder, and we can talk to that, I think they're all gone. They can't really print much more money. Then there is a risk that the price of the 10-year Treasury will fall, the yield will rise, and if you can wait for maturity, you'll get all your money. But if you worry about the value of your account today or tomorrow, or if you have to sell the bond in order to pay a medical bill, let's say, or have some other cash need, you could be in for a big loss. Because let's say the Treasury 10-year simply repriced to something more reasonable and sustainable, given there are taxes in the world to pay and there's inflation. If it repriced to 3.5% from today's 2% yield, there would be a major reduction in the current market value of the bond. And if you had to sell because you needed cash, you would take a large loss. That's my point about bonds. Not that they, not that they're going to default, not that they won't redeem at maturity, but that if you have to sell them because they're way overvalued now, you're exposed to some significant loss. That's why I say cash, because by cash I mean there's no principal risk. If you own a 90-day bill, Treasury bill, it's not going to reprice as interest rates normalize and come back to some normal level. You won't make any interest on it at the moment, but you're not going to lose your principal. The point really is we're in an era where the utmost priority, the number one, number two, number three goal of investors ought to be principal protection, ought to be, the maintenance of capital, not return on capital. The markets are just too dangerous after almost 20 years of this central bank distortion and falsification. So stocks should be out longer, and middle term bonds should be out. Cash should be king. And when the real correction comes and the stock market drops 30 or 40 or 50%, which I think it will, and when real estate drops in value because it's all driven by the easy debt that's available today, when bonds reprice to a more rational level compared to taxes and inflation, then there are going to be great opportunities to invest. But if you don't have the dry powder, obviously it's not an opportunity that you will be able to access.
And you wouldn't be a buyer of gold? You think gold's going lower? Is there any place in a portfolio for gold, either now or in the future?
Yes, I think there's a place in every portfolio for gold, but not as a speculative asset that you can time as to when and how much it will appreciate. I think it's more an insurance policy and an option on the ultimate failure of today's form of central banking. When finally the Keynesians, who were running all the central banks, the Fed, the Bank of Canada, the Bank of Japan, even the People's Bank of China, when they're totally repudiated, I think gold will soar in value. And if you have put your marginal resources into gold, and by marginal I mean resources you don't think you will ever need for current consumption or bills, then there is a once-in-a-lifetime opportunity here to hit the jackpot. But it may be 3 years, it may be 1 year, it may be never. But ultimately, gold is the one true monetary asset that's been proven by centuries of history. And when today's style of Keynesian central banking finally fails, I believe the world will come back to revaluing gold as a monetary asset. Today, it's just a trading sardine. It goes up and down and sideways depending on what's happening, in the trading pits in the big financial centers. But when the current regime fails, then its true value as an ultimate monetary asset, I think, will materialize, and there will be a lot of upside ahead.
Your book, The Great Deformation, you sell it on your website. You were telling me in the pre-interview, I got the cover art up here on the screen. You were telling me in the pre-interview that if you buy it through your website, you'll give people a signed copy. Talk about that for a second.
Yeah, that's right. I do have a blog that publishes daily called David Stockman's Contra Corner. The kind of issues that we have been discussing here today, I focus on, address every day. I try to post something. And beyond that, I post a lot of other writers and thinkers and analysts who have a similar view on the world. And this is not just U.S. oriented, it's global, and it covers the whole spectrum of issues, from central banks to the markets to stocks to a lot of topics in between. But on that website, you can order my book, The Great Deformation, and there's a procedure where if you would like some kind of special, message on the book,
Autograph from you.
That's right. I'm happy to do that.
Fantastic. David Stockman, the book, The Great Deformation, right here. David Stockman, thank you for joining us today on usawatchdog.com.
Right. Very happy to join and look forward to another conversation in the future.
Thanks for coming on.
Right.